Okay, Assalamualaikum warahmatullahi wabarakatuh. I'm Dr. Adli. Basically, I would like to say sorry to the earlier recording. The sound system was cannot be heard, so I'm re-recording the lecture on what I call it investment alternatives. Okay, investment alternative. Here I've written alternative investment. No, it's actually investment alternative. So okay, please bear with me for about maybe 20 to 30 minutes. I try to make it as fast as possible and as short as possible. Okay, so that we can actually continue on with our other stuff that we have to do in the evening, and then we can go for breakfasting today. All right, so um, going back to the chapter, okay, basically investment alternatives. So in investment, there are so many mechanism or investment vehicles that actually we can venture into. For example, you can go for, if you are a low risk type of people, you might want to go for only savings account, or you want to invest in tabung haji, or you want to invest in ASB, Amanah Saham, Berhad, and so on. So these are this is all depending on your risk tolerance, because you are really only adapting what you call it low risk investment. So maybe you want to go for that type of that particular vehicles, right? ASB, Tamoji, savings account, and so on. And if you are more towards getting more income, more return, so probably you want to have investment which are probably higher in terms of its risk, but provide higher or additional income to your wealth. For example, you might want to venture into bond, okay, bond or sukuk, and also might want to venture into um, in the stock market. Okay, you can also go into other what we call it derivatives, for which is high risk, okay, but probably giving a high return. So for example, option futures and so on. All right, now let's look at the first topic that we'll be discussing today, which is a non-marketable financial assets. Okay, all right, so before that just excuse me for a while, because I need to check whether the system is actually working well, and I would like to really know whether this audio is actually catching my voice clearly, so that there will be no problem afterwards. Okay, all right, now let's continue on. All right, so the first one is actually non-marketable financial assets. Okay, okay, first the keyword is non-marketable, and then the other word are financial assets. Okay, so basically when we talk about financial assets, we know that assets can be divided into two. Okay, because in our previous lecture I've mentioned to you that we have uh, real assets, and we also have financial assets. Real assets come from property that we buy, machineries, equipment, uh, factories, gold, and so on, which is real. We can see that, we can feel it. It's physically exists, right? As compared to financial asset are more or less is like the something which is uh, being transformed. Okay, it comes from real asset, but it's been transformed to financial asset. And when we talk about the non-marketable, which means that there is no market for it. There is no market. For example, what do you think which is financial asset that has no market? Savings account is one simple example. There is no market selling savings account. No market for selling savings, right? Um, so basically, it's commonly owned by individual, represent direct exchange of claims between issuers and investors, and usually very liquid, or easy to convert to cash without loss of value. Example, savings account, bonds, certificate of deposit, money market, deposit account, and so on. All right, you cannot sell it to someone else, right? Okay. And then you look at money market securities. Now, this is another level, which is the money market securities, which is marketable, claims are negotiable or saleable in a marketplace. And it is short-term, liquid, relatively low-risk debt instrument and issued by government, private firms. Example, money market, a mutual fund, treasury bill, and commercial papers. So this is money market. So basically, it is we call it short term in nature, right? It is short term in nature, very liquid. So basically, this is one of the instrument if you want to venture into the money market securities. Then we have capital market securities. Now when we talk about capital market represented by two. Okay, one is the debt market, the other one is equity market. So now let's look at the debt market first, which is we can say that it's actually bond market and also sukuk market. So bond is for the conventional bond, and then sukuk is for the Islamic bond. Okay, what is actually capital market securities? Basically, marketable debt with maturity greater than 1 year and ownership shares. So basically, it's either debt or shares. It's either debt or equity. Okay, so it's more risky than money market securities. So it is more risky. And then fixed income securities have specified payment schedule. For example, when we talk about fixed income securities, we are talking about the bond or the sukuk, because they are being known as fixed income securities. Why? Because, for example, if you look at the bond, for example, bond, when you purchase a bond, okay, you are actually providing capital for the issuer to use that capital for their projects, right? Probably let's say we use 1,000, okay, $1,000. So you give the money to the issuer. The issuer will use that money, and then you have a term of 10 years. So that $1,000 will be given back to you. Will be given back to you, right, at the end of the 10 years. So, however, during the from year 1 until year 10, you'll be receiving coupon interest. Okay, you will be receiving coupon interest if you are holding bond, and you will be receiving rental or profit if you are holding sukuk. So basically, it can be in semi-annually or annually. So if it is annually, then you will receive that coupon interest every year, right, until the end of year 10. So you will receive fixed income. So that's why we call it fixed income securities. All right. And then we look at the bond characteristics. Basically, buyer of a newly issued coupon bond is lending money to the issuer, who agrees to repay principal plus with the interest. All right, even though its interest is not acceptable in Islam. So I'm just actually giving some we call it examples of what this bond is all about. So if we look at bond, sukuk, for example, sukuk is the Islamic bond. The interest element has been replaced, okay, by profit, okay, and also rental, okay. All right. So the contract being used here are different. Bonds are fixed income securities. Buyers know future cash flows. We are certain about what will be our cash flows that we'll be receiving in the coming future. Known interest and principal payment. Now, if sold before maturity price, will depend on the interest rate at that particular time. All right. And also price quoted as a percentage of par value. Bond buyer must pay the price of the bond plus accrued interest since last semi-annual interest payment. Okay, all right. Then if it is a premium bond, so basically the amount is actually above par value. If it is a discount bond, basically the amount is actually below the par value. If you are talking about par value, let's say we take $1,000 as a par value, So if the bond is being sold at the price of 1,200, then it's a premium bond. If it is being sold below the 1,000, for example 700 ringgit, that is actually a discount bond. It's almost the same as the zero coupon bond, all right? So therefore the discount bond. Okay, innovation in the bond features zero coupon bond. Basically, zero coupon bond is the bond that I've been saying that selling at a discount. Okay, you can buy the bond at the price of 700 ringgit today, and then at the end of 10 years probably you get the principal back, which is they will pay back the 1,000. All right, so sold at a discount and redeemed for the face value at maturity. So basically locks in a fixed rate of return, eliminating reinvestment rate risk, and a response sharply to interest rate changes. Not popular with taxable investors, may have call feature which is we call it the callable bond. All right, now okay, now when we talk about bond, basically this is also another issue in our what we call it economy right now. When we look at the government expenditure income, so basically sometimes when you have a deficit budget, so this deficit must be financed by something. All right, must be the deficit must be financed by something. So if it is the deficit sometimes can be financed by issuing bonds. So that's how actually for example, Malaysian government issue Malaysian government bond. All right, we have cagamas, we have treasury bills, we have a lot of bonds that are being issued by the Malaysian government. Okay, so major bond type, for example, federal government securities, okay, federal agency securities, federal sponsored, and so on. And also we have this, what you call it, we have the government bond, we have the municipal bond, okay, state issued bond, and so on. And also we have bonds which are issued by corporation, by companies. They want to raise capital by issuing bonds. They get the money from issuing bond, and it can be done by corporation also. Okay, so we call it corporate bonds. Okay, usually unsecured debt maturing in 20 to 40 years, paying semi-annual interest, callable. So which mean that they can call all their bonds so that they can pay back their debts. Okay, they want to, for example, they want to reduce the debt ratio, the gearing, right? So they can call back the bonds and they can reduce their debt ratio. And then callable bonds give the issuer the right to repay the debt prior to maturity. So you don't have to wait until at the end of the maturity for you to pay your debt. Okay, and then we have also convertible bonds, which can be a bit sexy when we say that it can be can be converted to another asset. For example, it can be converted from bond to shares, so which is something that might be interesting for the bondholders. Instead of receiving fixed dividend, they want to have higher, or they want to have higher return and face higher risk. All right, so the risk with this type of bond, okay, is that even though you will receive fixed payment, we call it coupon, but you also be facing with the risk that the payments can be defaulted. Okay, the risk that the issuer may default on the payments. So for example, if the corporate or if the company cannot pay back the interest, okay, the coupon, and worstly is the principal, right? So if you can't receive the interest, it's okay, as long you can get the principal. But if you cannot get back the principal, then it's got to be something that which is very very sad to say. All right, okay, now for you to be able to understand what would be the risk that you are facing when you are purchasing bonds or sukuk, is the bond rating itself. they have been given ratings by certain agencies such as Standard & Poor Corporation, Moody's Investors Services Incorporation, and they are the firms that actually evaluate, analyze the company, the corporation, the government, that, and also look at the capability of payment, and also the financial position of the company or the government. And then we look at the issuer's relative probability of default, and when they have done that, they will give the bond a certain ratings. For example, rated triple A, double A, triple B, and typically institutional investors are confined to bond in these four categories only. All right. So if you are from, for example, basically who are the buyers of the bond? Okay. The buyers of the bond or suku, for example, in Malaysia, if you look at the Malaysian debt, basically majority of the bond, or the subscribers are the local institutional. For example, the EPF, KWSP, Kumpulan Wang Simpanan Pekerja, ataupun if we call it in Employees Provident Fund, Tabung Haji, Hazana, and so on. There are a majority are from local institution, big institution with big money, big fund, right? And probably about 30% or less than 30% are being held by the foreign investors. So basically about 70% of the bond of the debt are being held by the local institution, and 30% are being held by the foreign institution. So when you are looking at this type of investors, they will only look at these probably triple A, double A, and triple B, what you call it, rating only. All right, now let's look at the other, what you call it, rating, which is more speculative in securities, more speculative bonds rated double B, B, triple C, and C. Okay, because it did not provide certainties. It did not say that, okay, we are capable of paying the investors. Probably not really, not saying that. Okay, but basically the ability might be questionable, right? Probably the companies might be doing well, or maybe they will not be doing well. So that's idea. So basically these are speculative securities, it's actually only certain investors will actually invest in this type of securities, okay, rated double B, B, triple C, and also C. And now let's look at one thing which is very important when we talk about the debt market, which is the securitization. Securitization. What do you understand about securitization? Now, all right. So I think we will actually have this before we go. I would like to end this session at this moment. So I will continue on the securitization afterwards, because if it's going to be too long, then the file that you have to download is going to be too big. So with that, I would like to end this session here, and we'll continue on in the next video. So probably we'll see you in just a few moments. Okay, Assalamualaikum warahmatullahi wabarakatuh. Dr. Adli, dunia dapat, akhirat dapat.